How's it going, everyone? Welcome to another video. Now I'm going to be covering premium versus discounted. Now premium versus discounted is a relatively easy concept, and it can be quite useful when using it in the market. So let's start with understanding what premium versus discounted means and the significance of it. Now premium versus discounted, essentially what it means is premium pricing and discounted pricing. Now in simple terms, it is expensive versus cheap. Now, to give you guys an example and also a better understanding of why premium versus discounted is important, I'm going to give you a quick example of how it works. Now, say you're buying maybe an iPhone, right? And some shop sells it at maybe $3,000, right? $3,000, an iPhone, right? And maybe the Apple Store, they just sell it for $2,000. Now, when you essentially look at premium versus discounted, what it means is when you ask yourself, what phone would I buy? Would I buy the phone that is $3,000 or would I buy the phone that is $2,000? Now, the obvious answer, and we all know it, right? You can touch your hearts and ask yourself that most of us, if not almost all of us, would buy the $2,000 iPhone because the $3,000 iPhone is just overpriced, right? You don't really need to pay that much. Similarly, in the market, when people want to buy something, so essentially leading me to my example here, when people want to buy in the market or essentially place their orders, they do not necessarily want to place their orders in an expensive place. You don't want to buy expensive because you want to buy something that is relatively cheaper so that when the market moves higher, you can make a lot more profit. And it's also a logical place to put your orders because you want to buy cheap and you want to sell expensive. So that's what it means, right? So looking at this example I've made, you've essentially got an example of how a demand zone lies within a discounted range. Now this is a discounted range, this is a premium range, right? So these are two different places we essentially have our charts marked up with. Now we have a discounted range in this region where a demand zone lies within it. And likely you'll see a mitigation of a demand zone that lies in a discounted range. You will not necessarily, and you probably won't see this at all, where price reacts to something that maybe lies within a premium range, and you may not actually get a good trade from there because you are trying to buy from a premium zone, and that does not conceptually make sense. There will not be enough volume or a lot of volume to actually push price in respect to your zone and follow through with your weight, right? Maybe creating a new higher high. Now, that is why we use premium versus discounted. When you mark up your charts, right, and you want to figure out whether the zone you've marked up makes logical sense, simply look at the low and the high points of the market, the significant swing points. Now you might be wondering, how do I spot significant swing points? The best way you can essentially spot significant swing points is use the line graph. As all of you may know, you've got different methods of actually displaying the data that TradingView offers. So use the line graph, which is this one that I use, and it will allow you to see the market in a much simpler light. Right? Not a lot of candles, not a lot of noise. You're just going to see lines and how the market has formed. This is one of the best methods I use personally to spot swing points in the market. Now, another thing that I have is I also use the higher high, lower low live indicator. Now, this is an indicator that's already in the FAQ section. So if you do want to add it on, add it, and you can use that to spot significant swing highs and lows. So I've covered an example of demand zones here. Let's look at supply, right? Now, when you want to sell something, you want to sell it at a high price because that way you're essentially earning more money. So when you're looking for a supply zone, you want to make sure it is within a premium pricing so that you can sell it at an expensive price, right? And that really applies to a lot of your POIs that you choose. Now, some of you may notice that when you actually look back at your backtesting data, some of the losses you have were not actually those zones that you tried to trade off of. They weren't in a premium or discounted zone. Now, by applying this to your charts, you will be able to understand why the market essentially did not respect that trade you took and why it pushed down further or pushed up further. So that will be all for this lesson. It is a very simple lesson of understanding how to use premium versus discounted and the significance of it within the market. And I think the best way for you guys to absorb and learn this method is go to your charts and start marking up the highs and lows in the market and just use this Fibonacci tool. So just to quickly show you guys what the settings are, all you have to do is essentially take the 0, 0.5 and 1 and put whatever style you want. Right, my style is essentially just a sort of white color for all of them, and that's how it looks. So using this tool, just start marking up stuff and look at where premium and discounted zones lie, and also look at where price usually starts reacting from. Chances are you'll see price reacting to the specific regions I've just talked about, and that will give you a better idea of how to utilize this and also train yourself to see them. So that will be all for this video. I hope you've enjoyed it, and I will see you in the next one.